In today's video, I'm going to be talking about my picks for the top 5 stocks for the rest of 2022 if you're looking for dividend income. Dividend income is amazing. I love it. I make money from it, obviously. That's why I have this channel. So let's get down and let's check out my top 5 picks for the rest of this year. First is Fortis, FTS.TO, of course, that would be Toronto. Anyways, it's a Canadian stock. All of these are going to be Canadian stocks, but either way, Fortis is absolutely amazing. First off, it has 3.5% dividend, which is amazing, and its average volume is 1.5 million shares per day. That means that it's going to be very easy to buy and sell unless you're buying millions of shares, and I really doubt anyone watching this video has $59 million. As we can see, over the past 2 years, it's, of course, increased its price of its stock. Now, of course, everything has. What I'm looking at, however, is the last little bit of time, and that is, of course, has it decreased the same, if not more, than the market, and has it increased since that bottom? And it has, and of course, from its top of about $64.50 to, let's call it $59.50, that's around a $5 decrease, which is a lot less than what the market is. The next thing I really want to look at is the dividend. Are they increasing the dividend and how often they pay it? They tend to pay their dividends every quarter, which is fantastic, and they have been increasing it about once per year. If we look at their earnings income as well, or at least their past earnings, we can see that over the last couple of quarters, they've had 2 misses and 1 meet, and they have been increasing their revenue while decreasing their earnings. Earnings is their profit, while revenue is their total income. Next is BMO, which is the bank that I've been buying a lot of recently, mainly because its PE ratio is so low. It's gone up since I've last purchased it. And at 7, it's fantastic right now. There's very few times ever that a Canadian bank, at least in recent modern times, has been this low for the PE ratio. And it's at 4.5% dividend. It's pretty solid. It's getting a couple million shares traded per day. This seems like a very solid stock to get right now. It has decreased heavily, mainly because of recession fears. Yes, we're in a recession. I don't care what people are saying, how they're trying to change the term, the definition of a recession. We are in a recession. We've had 2 negative quarters of GDP. However, something I want to show is this. Right now, it's broken above its top support level. We need to see where this is going to go. Will it continue to go down, or will it go up? Has this been the bottom? It's very hard to say right now, of course, with the world and everything that's happening. However, this is a significant drop, and if you are looking at a 10, 20, or even 30-year period of time to invest, then this would be the type of drop that I would be looking for. And I don't mean go all in, say like I got $20,000, I'm going to go all in with 20 grand. No, you want to go in a little bit at a time, because we don't know if this is the bottom or not. We don't know if this is recovering slightly from the bottom. We don't know. For all we know, there could be a world war that happens in 6 months. We don't know. So you want to go a little bit at a time. You don't want to go all in, because at that point you're gambling. You might as well slowly build your portfolio. You don't want to go all in at once. Are they increasing their dividend? Yes, they are. Now, of course, there is a time recently where they were not allowed to increase. That was because of COVID, the virus. I'm going to get demonetized because I said that word. But either way, the Canadian banks were not allowed to increase their dividend. They have recently, and they are continuing to increase. They've had 3 beaten quarters, which is fantastic. 1 massive one right there. And of course, when we're looking at yearly revenue, a good increase, but look at that earnings versus prior years. That's huge. Next is Capital Power Corp, CPX. You're probably wondering, what does it do? Well, Capital Power Corp does acquire, own, and operate renewable thermal power generation facilities in Canada and the United States. It generates electricity from various energy sources: solar, wind, waste heat, natural gas, coal, blah, blah, blah. Basically, what I'm saying with this company or companies like this is we need to look into the future, and as we know, of course, the governments, no matter if you like this idea or not, they're pushing away from gasoline-powered vehicles and they're going to electric. What does that tell us? Electricity is the future. If we're looking at a 10 or 15 or even 20-year investment or even longer, companies like this is what you're looking for, because there's going to be more and more power needed on the power grid. We're going to be needing more and more of these high-powered lines going across the country. We're going to be needing more wind, solar, and everything. And basically, we need more electricity, and companies like this are going to benefit. It pays a 4.7% dividend and has 500,000 shares traded every single day. Its PE ratio is quite high, but that's of course because probably people are looking ahead like I am right now. Also, something very interesting is it hasn't had that same drop as the rest of the market. It's continued to go up. All throughout this year, this company has continued to go up while not dropping. And they pay a dividend. Every quarter they pay a dividend, and they seem to increase their dividend every quarter. Every year, sorry. Every year they seem to increase their dividend. Their earnings, they've had 1 missed quarter, 2 beaten quarters. Their earnings are starting to go down versus 2018. They may be looking to increase, of course, in their own investment into themselves, which I have been hearing, and their revenue has kind of stalled. Next is TransAlta Renewables. Same idea. They're an electricity company. Huge PE once again. 5% dividend, 5.2% dividend, 300,000 shares being traded. Yahoo's only showing a chart back before 2021. However, they have been slowly on the decline, but they have stabilized. So this is not a company that I would be putting a lot of money in at this point in time unless you really are looking deep into the future. But at 5% dividend, it is worthwhile looking at. TransAlta develops, owns, and operates renewable power generation facilities through wind, hydroelectric, gas, and of course solar, US gas, Australian gas. Yes, it's an electricity business. They pay a dividend, but they don't tend to pay a dividend increase very often, but they do pay a dividend every month. Last time they increased their dividend was August of 2017. They haven't done so since. Their earnings are better than the previous year. However, it is lower since 2018, but their revenue is higher as well. They've had 3 missed quarters as well, which is kind of hard to get your stomach into a stock like this. But if you're looking to look into the future, that's something that pays a dividend every month, this could be an option. CIBC, of course, I'm huge into Canadian banks. This one has another low PE ratio. Anything below 10 is something that I usually look at when it comes to banks. 9.26 is really good. 2 million shares traded last time, about 4 million average. Pretty crazy. 5% dividend as well, which is nice. Just like all the other banks, they've gone down, but something again that I do like to look at is the fact that these banks, they are now trading above that trend. They are also increasing their dividend too, just like all the other banks. They couldn't for a very long time. They've had 2 out of 3 missed quarters, and their past year they've had record revenue and record earnings. Why I think the Canadian banks have had record earnings and record revenue is because, of course, they've figured out how to make money without much money coming in, because they're charging fees. But when it comes to their earnings, why they're making more money is because they're closing down branches, at least a lot of the banks are, and they're getting rid of a lot of staff because, of course, computers are doing everything these days. Something that you can look at is an ETF that has a lot of the different Canadian dividend stocks. ZDV is a good option. This is 4.15% dividend. Volume isn't crazy either, but you're going to be trading with the trends when it comes to the actual stock price. Same as the market, it's trading above its trend line right now, so it's kind of looking interesting right now. It's also increased its dividend recently too, which is nice to see. It also pays a monthly dividend. Its top 10 holdings are Enbridge, which was actually almost made my list. Royal Bank, Bank of Nova Scotia, any Canadian bank is worthwhile holding. You can buy all of them at the same time. It doesn't really matter. Canadian National Railway, I don't own right now, but I have owned in the past. TELUS and Bell, I usually stay away from, but they do pay a nice dividend. TransCanada is also interesting too, but there's just so much negative stories when it comes to, of course, gasoline, because, of course, the entire world, or at least the governments of most of the world, want to take people away from gas and oil. To me, I understand why, but at the same time, it doesn't make sense at this point in time, because guess what? If we want lower inflation, we need lower gas prices, which means we need more oil being mined. We need more gas. So overall, those stocks, Yes, they'll be making more money because, of course, there is so much of demand right now for oil and gas, and the price is sky high. But into the future, companies like Enbridge and TransCanada, Enbridge is doing more. They're investing more into solar and obviously wind power as well, that they still are great options into the future. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.